Good afternoon, ladies and gentlemen. My name is Michalis, and I'm one of the market analysts here at HF Markets. And today we're going to be looking at a different topic to what we have been looking at over the past 2 weeks. Today we're looking at something specific. We're looking at position sizing. Now, in regards to position sizing, yes, of course, we're referring to the position in terms of the size of our investments, but we're going to look at it in slightly more detail because, of course, when we're trading derivatives, such as, for example, CFDs, but also generally speaking, any type of derivative, which includes leverage, there's, of course, not necessarily just the importance of the size of the position. But today we're going to look at different aspects to the position size. We're going to look at, for example, the required margin level, free margin. We're going to look at, for example, scaling in and scaling out, how we can use techniques related to position sizing, because a lot of people, they speak to me about, help me with a technique which is going to, for example, determine how the market is likely to move. And we look at a lot of techniques and strategies in regards to that. But very rarely you will see an educator going so far into depth about trading, where they actually start to look at strategies related to the actual size of the position. And this is actually something which is very interesting. It's something that definitely can help a lot of traders get a better understanding of the financial trading markets. Now, today's webinar is going to last no more than 55 minutes. We don't want to spend so much time and give you so much information, of course, that it's too much for people to actually take in, and it starts to become a little bit too much to handle, of course. But today's webinar is going to be split up into 3 sections. Very quickly, we're going to have an introduction. Then we'll start looking at some of the basics of position sizing and risk management. And then in the third part of the webinar, we'll go straight to looking at scaling in and scaling out, and different ways in which you can use scaling in and scaling out. Because there's certain ways of using scaling in as well as scaling out, which can significantly increase the risk. And there's other methods which really work in the favor of the trader. And we're going to explain exactly how not to trade using scaling in, or not necessarily how not to trade. Of course, you can trade as you personally wish, but where certain methods have disadvantages and where certain methods have a lot of benefits for us as traders. Now, as part of this slide, I, of course, want everybody to be aware 2 things. Number 1, we are dealing with an investment. Now, as with all investments, there's a risk to the capital that you are trading because it's an investment. We do have a practice account known as a demo account. So for those individuals who aren't experienced traders, and this is potentially why they're watching educational webinars, they also have a free practice account which they can test different aspects of the market and a lot of things that we may be speaking about throughout today's webinar and in webinars in general. The second thing I want to say to everybody is that, of course, these webinars are not here to give investment advice. Now, I used to be a financial advisor, so I know very, very clearly the difference between investment advice and educational material. So these webinars are here not to give investment advice or financial advice, but they're here to give you as much educational material as possible. Because yes, we don't want to give advice, but we want to give you as much educational material in order for you to have the knowledge, the confidence, and the expertise to be trading in the financial trading markets with full knowledge. So this is what I wanted to say as part of this slide. This is the last slide as part of our introduction. I only want to spend a few minutes as part of the introduction because look, it's not going to make you successful. It's not necessarily important to today's topic, but I do think it is important to know a little bit about the individual who is providing you with this information. So like I said, we've got a big team actually of an analyst here at the office. My name is Michalis. I am one of the market analysts here. I've been in the financial trading markets for 10 years now. I originally started off as a financial advisor for almost 5 years. That was in London. That's going back quite a few years now. I have been a market analyst for 6 years, and webinars tend to be based on the two sides of trading. The side of trading which is related to trading techniques, trading strategies, trading methodologies, and so on and so forth. And then the other side is more related to how to use the platform, basics, looking at risk management, trading plans, and of course today we're looking at position sizing, which can come under risk. It partially comes under risk management, but also partially comes under trading plans as well. So that's what we have to say about it as part of our introduction. And I want to go straight to looking at position sizing. This is a great webinar, by the way, ladies and gentlemen. If anybody also watched my last webinar from last week, last week's latest webinar was related to risk management. We looked at a lot of different aspects of risk management, including how you can mitigate risk, how to spread the risk, also how you can use risk management plans and trading plans to mathematically be a successful trader, regardless of whether you are able to successfully benefit from the, regardless of whether you're able to successfully determine how the market is going to move. Because we had a lot of individuals throughout this year so far who says, I cannot determine how the market is going to move successfully. I cannot do it enough in order for me to be profitable. And I continuously say to traders, if somebody can not determine how the market is going to move within a specific period of time, so sit in front of the screen today and say, today the price is going to move in this way. Tomorrow the price is going to move in this direction. If you're unable to be able to analyze the market with such expertise, you can still be a profitable trader, as long as you have the mathematics of your trading set up correctly. Now, we had such great feedback about this. People's minds were absolutely blown that somebody who has a 30% success rate can still be successful, and somebody who has a 90% success rate can be successful. And also the other way around, somebody who has a 95% success rate may not be successful because the statistics behind this trading are incorrect. Incorrectly set up, should we say. Now, because I had such great feedback about that, we're going to slightly touch base on it today. But if anybody's interested to really see in depth how you can amend your trading plan to ensure that you are successful regardless of your success rate by looking at the statistics of trading, then of course the previous webinar is definitely going to be massively beneficial. And if anybody's interested in that webinar, of course, feel free to get in touch with our support team via live chat, and they will 100% provide you with the recording. So position size. Why is position size so important? A lot of people are probably going to say, you know, what's so important about it? You know, I'm looking to invest in the stock market. I want to buy Alphabet stocks. I want to buy Nvidia stocks, whatever it may be. It's very simple. How many stocks do I want to buy? If I want to buy 2, I will go ahead and buy 2. Now, if you're looking to build a portfolio, then to a certain extent, the position size may not be as important. Yes, it's more related to not strategies and techniques, but more related to money management, if that's the case. But if you're actually trading, and of course, when you're looking at CFDs, when you're looking at derivatives, they're mainly designed for traders rather than individuals looking to build a portfolio for the next 10 years. When you're doing so, the position size is extremely, extremely important. Now, something that we spoke about in the previous webinar, and I'll mention this as the first thing today, is that before you enter your trade, you have to think about where you're going to enter, where you're going to exit, regardless of if the market is going to move in your favor or if the market is going to move against you. So, for example, let me get my pen out and we can draw an example here. Let's say we've got some market movement. The market movement's doing something like this, and then we get a downward, a larger downward impulse wave with more momentum. We've got bearish breakouts, and a lot of individuals are probably going to believe the price is going to continue to decline. Regardless of that, before I enter into the trade, I should know as a trader that if the market moves in my favor, I will exit here. And if the market moves against me, this is the point where I'm going to exit. Okay, so before I've even opened the position, opened the trade, I know my entry, I know my exit, and I know if the market moves against me to this area, this is what my loss will be. And if the market moves to this area here and I'm in a profit, this is the amount of my profit. I have a lot of one-on-one sessions with high net worth individuals, also who are trading, of course, with HF Markets. And they say to me, you know, I opened this trade and I earned so much more than I previously expected. And they expected me to go and say, that's great to hear. Whereas actually I said, if you are making more than what you expected to earn on that trade, then you're doing something very wrong. Because if you earn more than expected, then nothing is saying that on another trade you're not going to lose more than what you expected. And that's definitely not something that you want to experience and shouldn't ever have to experience, whether you're an experienced trader. Because I've got somebody who says, I've read the beginning of his question, and he said, I'm an experienced trader, and then he wrote his question. We've got experienced traders. We've definitely got some people on today's webinar which are not experienced traders. Regardless of whether you've got experience or not, you should not be experiencing more loss than you expected. And the same applies to profit. This is the very most basic thing about any investment, ladies and gentlemen, and especially when you're trading, which is more short term, should we say, as well. So entry, exit, we should always know when we're going to enter. We should always know, even before we get to that point in the market, that these are the prices that we're going to exit the market. We should always know our profit, and we should always know our risk. Now, if we know our entry and we know our two exit points, in order to determine what the potential profit is going to be and what the potential loss is, then we have to be able to know what the position size is. So we need to ensure that in order to be within that bracket of responsible trading, where you've got maybe it could be a single target, maybe 2, 3 targets. When you've got these targets and this as a wall in terms of where you're not willing to go past that in terms of a loss and a risk, in order to determine that bracket, ladies and gentlemen, you have to be able to place your position size appropriately. Now, I don't want to go into too much depth at the moment as part of this slide. Believe it or not, this slide is actually, I interpreted it and meant for it to be slightly more basic and then build into something more advanced. So let's work through the bullet points, and slowly, as I said, we are going to go, of course, more and more advanced. So position size, what we're referring to as a position size. Because if you've never traded before, you're probably hearing people say, I bought this many stocks, but you probably never heard somebody say, what's your position size? Okay, so a position size is very much referring to how much you are investing. Now, when you're referring to the position size, it's not taking into consideration leverage. So for example, when you're looking at your trading platform, okay, now some people are using MT5, some people MT4, some people are using our platform on the mobile app, and I'm actually switching to the third point here. Now, here in terms of the position size, you may, depending on what platform you are using, you may see it as lots. So for example, I've opened one lot. So one lot is the position size. I'll explain it, of course, in more detail. It may be units, okay, depending again on what platform you are using, and of course, depending on what asset you are trading. Now, what exactly is one lot? Very simply, we're not going to go through all the different names for all the different position sizes. It's not necessarily important, but one lot, ladies and gentlemen, is 100,000 of a currency unit. So for example, depending on the currency pair, it may be US dollars, it may be euros, and so on and so forth. Now, the position size is not taking into consideration what is known as leverage. Now, we have to take into consideration when we're looking at leverage, leverage increases our buying power. Now, for example, leverage will always be shown as a ratio. It could be shown, for example, as 1 to 10. It could be shown, for example, as 1 to 1,000, and so on and so forth. So you can have a high leverage, you can have a low leverage, you can have no leverage at all if you really wanted to. But because you're using leverage, we are increasing your buying power. So if you're looking to invest $100,000, which is one lot, so you're opening one lot position size in the Euro USD, but you have a leverage of 1 to 10, then actually you are only required to invest, ladies and gentlemen, 10,000. So you are able to trade and buy and have a position size of 100,000 US dollars, but actually you are only required to purchase that contract. You are only required 10,000. Okay, and this is one of the big benefits of leverage. We are increasing your buying power. So the important thing, ladies and gentlemen, of the position size is what is known as the margin. Okay, now margin, there's different types of margin that you're going to see on the platform and that you're going to see as part of today's webinar. We're going to focus though on 3 margin levels. The first one, ladies and gentlemen, is called required margin. The third one is free margin. And the second one is free margin. And the third one is margin level. Now, what exactly are these referring to? So let's go to the next point. Let's go to point number 4 here. Required margin is the amount of capital required to open the trade. So in order to open that position, this is how much is needed in terms of actually your money, in terms of your capital. So for example, if you've got 1,000 US dollars in your account, the required margin is how much of that 1,000 US dollars is required to open a trade. Because the position size is, for example, 100,000. Now, people may not have 100,000 in their account. So it doesn't mean if you see the position size on the account that you are opening at 100,000, okay, doesn't mean you need 100,000. You need to look at, of course, the required margin. The required margin is saying, this is the portion of the position size that you personally need to input. The rest is made up of leverage. Okay, so let's look at that example that we previously looked at. Let's look at, just so people have a good understanding. If you've got a position size of 100,000, so you're looking to buy 100,000 in euros against the US dollar. Okay, you have a leverage of 1 to 20. Okay, please ignore my my handwriting. I'm using unfortunately a computer mouse to write. So if you've got 100,000 in terms of the position size, you've got a leverage of 1 to 20. It means you're increasing your buying power to 1 to 20. So that means you have a required margin of 5,000. Okay, and actually 95,000 is made up of leverage, because you have to think 1 to 20. So that means 5,000 times 20 is 100,000. So the margin, ladies and gentlemen, the required margin is the 5,000, and the 95,000 is leverage. Okay, it's just the platform increasing your buying power. So this is what required margin is. In simple terms, it's the amount which is required in order for you to open the trade size. Okay, so like I said, it's always important that we look at the position size, but not necessarily whether it's 1 lot, 2 lots, 3 lots, and so on and so forth. But it's more important to look at the required margin. Then we have free margin. Okay, so let's say we've got the same example. We have the required margin of 5,000. So I need 5,000 to invest into 1 lot of the Euro USD. Right. So let's say I've got 10,000 in my account. 5,000 of that actually was invested in the Euro USD. So that's in the market. What is free margin? My free margin, ladies and gentlemen, is actually the 5,000 which is left in my account. So what is free margin? Free margin is the money in your account which is not tied up in other trades, which is free for you to open more trades. So I have spent 5,000 and I have 5,000 more to spend and invest on other assets. So it could be the Euro USD again, it could be on stocks, it could be on indices, it could be on commodities, whatever, of course, it may be. So we've got a good understanding of margin, free margin, and required margin. This is something very basic. Of course, it's not necessarily going to help you as a trader in terms of your trading to earn more money. But what I want to do is make sure everybody has a good foundation before later on in the webinar we start looking at things which are a lot more advanced, where we actually start to look at how you can improve your trading, improve your entry, your exit, and potential profit, of course. Now, how do you work out the required margin? Because I can see some people have already stated to me, I'm trading on MT5. I've got an individual who's trading on MT4 as well. Okay, so I've got two people saying they're trading on the MT5 and it gives them the position size, but it doesn't actually tell them what the required margin is. That is correct, ladies and gentlemen. So one thing that you can do, and I wouldn't recommend it, is to know the calculation, and each time you open a trade to do the calculation, and it tells you how much is required. This is the harder method. You don't need to do this. We're going to skip that point just for a moment and go to this point here. If you are using the platform which doesn't tell you the required margin to open a trade, just go to our website. We have a very simple calculator. I'll show you the calculator on the next slide. And it will very, very easily show you how much is required to open the trade. So you go to the home page, go to tools and education, go to tools, go to trading calculators, and then go position size calculator. And that is a very simple calculator on how to work out the required margin. Now, if you don't want the calculator to do it automatically for you, of course it is great if you do know the calculation. You're very simply just taking the exchange rate. So for example, I've got the example here actually. If we're looking at the Euro USD, this is the exchange rate, which I just took the price from the MT5. Then we times it by your lot size. Remember I said that one lot is 100,000, okay? Of course, you can have half a lot, you can have a mini lot, a micro lot, which is a very small position. One lot though is 100,000. You can open more, you can open less, of course. But just for the example, we're going to say we're going to have one lot. So the position size, so you're taking the exchange rate times the size of the position, and then you're dividing that by 100. That gave us, ladies and gentlemen, 1,084. That very simply is a required margin. I've got a question. I'll answer the next question as well. I've got an individual who says, how do you manually work out the required margin for oil? I've got somebody else here who says how to work out the required margin for the NASDAQ. By the way, so these two people have sent private messages. You do have the option to send private messages, or you can share it in a way that everybody can see your question. I've got another question. Do you do a manual calculation for required margin for gold with a leverage of 1 to 400? Guys, what I would say is the calculation for the, because people are saying different assets, okay? I'm not going to go through all of the calculations because very simply there's a calculation on the website. It's very, very easy to use. I've got the calculation on the screenshot here. But what I will do is if you send me an email directly or you speak to the support team, they will provide you the calculation, okay? It's a very simple calculation. Of course, it's slightly different when you're looking at gold, when you're looking at, somebody mentioned NASDAQ, somebody else mentioned oil. It is slightly different, but more or less the same concept. But to be honest with you, I wouldn't necessarily be doing the calculation manually. Very simply because there's a calculator on the website. It's free, it's easy to use, it's much quicker, and it's saving you the hassle, to be honest. But of course, if you want to, send us a message on the chat, live chat, send me an email, and in a couple of seconds, I'll send you the calculation for whatever asset you're looking to trade, because people are sending different assets. And if I go through all of them, we're going to be here a very long time. So hopefully people understand. Right, so let's go to the next slide. Now here, ladies and gentlemen, we can see the calculator. The calculator is very simple. Just confirm your currency of the account you are trading. Okay, I've clicked here US dollar, but of course you can change that. Account leverage. So somebody said actually his leverage. Somebody said he had a leverage of 1 to 400. So here he would very simply put 400. Just for the example, though, I've put 100. Forex is the type which I'm trading. Of course, somebody mentioned NASDAQ. Here you would click on indices. Somebody mentioned gold. Somebody mentioned oil. You would click commodities. And then there will be a list of assets. You click on the one which is appropriate for you. So I've completed that. I've typed in the volume, so one lot, or some people may be looking for units. The same applies. You click calculate, and it instantly, within a second, a very max, will confirm the required margin. So this is why I'm saying, you know, you can use a calculation. It's absolutely fine, but it's not necessarily when you've got the calculation available for you for free. Then the next thing I wanted to look at is margin level. Now, margin level is something which is extremely important, and it's not extremely important only for management, because of course when you're looking at position size, we're number one going to look at how we can use and look at position size in terms of risk management. The second part of the webinar, we're going to look at position size in terms of what methods we have which can actually benefit our entry. So for example, scaling in and scaling out. So we're not only going to focus on management, we're also going to look at how we can use position sizing at different levels in order to better our trades and better our success rate. But when we're looking at margin level, we are looking at management, but in addition to this, we are going to look at things to look out in terms of the margin level. Now, margin level is important for two reasons. As we can see here, the margin level confirms your exposure and it also confirms your risk. Now, the calculation for margin is very simple. You just take your equity and you divide it by used margin and you times it by 100, and that will give you your margin level. Now, some people will say to me, how do I work out my margin which is currently used on my account? How do I work out equity and so on and so forth? To be honest, you don't need to work it out again. I could go through the calculation. I don't think it's necessary because it's very simply stated on your MT5. So here, for example, I've got a screenshot of the MT5. I opened just random trades, I think 10, 15 trades randomly, just to show you. So here it says balance. So my balance, ladies and gentlemen, is basically the amount which I invested plus my closed profit and loss. Now, what do I mean closed profit and loss? It's the trades which I have closed. It's not taken into consideration trades which I still have open. Okay. Then you've got equity, which is this here, just over 93,000. This includes my balance, so closed trades and the amount I invested, plus it also takes into consideration my profit and loss from open trades. So of course, equity is more important than balance. I don't want people to be looking at balance and say, I invested 100,000 and I'm already in a profit of 1,394. It's not important. What is important is your equity, because there's no point your closed trades being in a profit if your open trades are in a loss. Now, this is also specifically why I opened these trades, so I can show you that as well. A lot of people get into a bad habit of, as soon as the trade goes into a profit, they close it. So they've got a lot of closed trades which are in a profit, but all of their losing trades, they refuse to close. And this is actually one of the reasons, ladies and gentlemen, beginner traders sometimes experience bad results from trading, because they close trades which are in a profit very quickly, which isn't necessarily a bad thing, depending on your market and trading approach. For example, scalpers do that, and it's absolutely fine. But it makes no sense refusing to close trades which are moving against you and only closing trades which are in your favor, because there is a substantial amount of risk to that. Then you've got margin. Okay, so this is the capital which I have invested in trades currently, so open trades. And we have free margin here as well. And then you have your margin level. So it's automatically calculated for you. But as always, I have put the calculation here. You're very simply just taking your equity, you divide that by your margin, which is here, and then you times it by 100, and that will give you your margin level, which here is 478%, and it's always shown as a percent. Now, the lower your margin is, the more you are exposed and the more you are at risk. So we need to take that into consideration. As I said, the margin level is designed to show you how much you're exposed and how much risk is currently involved for your account within the market. Okay, so another thing people need to take into consideration is a margin call, which is depending on your margin level, and the stop out. Now, the stop out level, again, is dependent on your margin level. So this is why margin is extremely important, okay? And this is why people say that you shouldn't have a very small margin level, a very low margin level, because you're very exposed and you're at high risk. Whereas, for example, here you can see I've got a margin level of 478%, so it's generally quite high. Now, what is a margin call? A margin call is an email, okay, which is basically a warning email, which is telling you what options you have in order to better your trades and your trading account and your circumstances. It's known as a margin call because if we go back 20-30 years, it was actually a call. Now, the email, ladies and gentlemen, it will say that you have three options. You have, number one, the option to add more money. Of course, if you add more money, your margin level increases. Or you have the option to neither add money, withdraw money, or close trade. So you have the option to do nothing. The third option is you have an option to close a trade or some trades, which again frees up margin and your margin level increases. Now, some people will say to me, should I add more money? Is it better to leave everything untouched, or is it better to close trades? And the answer is it depends on the circumstances of the market. And I'll explain which is the best depending on how you feel and believe is going to happen within the market. So if you've got, let's say, 5 trades open, all right, the market for whatever reason has moved against you. If the market, and you know, these 5 trades are in a loss, if you look at the market and you think all these 5 trades are going to move in your favor today, you are 100% certain, you are imminent and certain that these trades will instantly move in your favor, then it makes sense to either do nothing if you think it's going to happen very quickly and you have enough space in the market, or you can add more money to give more time, okay? And what this allows is more time in the market and more space, and the market, of course, moves in your favor. The trades go either to break even or more competitive exit point or profit, and you start to close them then. Okay, so this is if you believe the market's going to move in your favor. If you don't think the market is going to move in your favor, then you need to look at your trades and say, look, I don't think these are going to move in my favor. Why am I going to keep risking more and more and more money? Let's close the trades which I think are not going to move in my favor and free up the margin. Okay, now what does this do? This, number one, allows you, if you want to withdraw, you can withdraw money, rather than the market keep eating away your money. Or option number two, you free up capital in order to start your recovery process, okay? To recover your capital, to start to earn potentially after that, and so on and so forth. Now, the stop out level also is in relation to your margin level. The margin call will be sent to you at 50%, which is very low. For example, if you look at here, I've got a margin level of just under 500. The margin calls at 50%. The stop out level is basically when the system will automatically start to close your trades. Whether you want to or not, they will automatically close your trade. If you don't want that to happen, then of course you invest more money, it creates more margin, and you don't get stopped out. Okay, so option in terms of the stop out level, the way the stop out level works is the stop out starts to happen at 20%. So your call, your margin calls at 50%, your stop out will start at 20%. So let's say, for example, I've got one trade which is minus 100. I've got a second trade which is minus 500, and a third trade which is minus 10. Okay, it will automatically close the largest loss first, so the 500, then the second largest loss, and then the third largest loss. Okay, and the reason this happens is, of course, we protect you against negative balance and to ideally leave some capital as well, rather than you have all of the capital being eaten away from the market. Okay, so this is also something for us to take into consideration. So I've got another question. Let me see if we can answer this question before moving to the next slide. This individual has a question which is not related to position size. If anybody has questions about their own experiences or something they need assistance with within the market, of course, feel free to ask 100%. And we also will have a Q&A section at the end of the webinar specifically for these questions. If there's a quick answer though, I'll answer it. Otherwise, we'll leave it to the end and we'll answer it at the end. I've got somebody who says if I can recommend, this individual saying if I can recommend the trader for them to copy. No, unfortunately, as I stated at the beginning, we can't give advice. Recommendations are deemed as advice. What we do have though is we have webinars every 2 weeks, which is specifically about copy trading, and we have a lot of information there in terms of what information is available to you about the traders, which can help you to make a better decision on who to pick to copy. This is point number one. He also says sometimes, he also says at the moment it's not working. Maybe it needs to be enabled for him, or maybe it's not available for that account type, because keep in mind, copy trading is only available for certain account types. It's not an issue though. Send a message to live chat, which is available on the website, and in a couple of seconds they'll reply to you. And it's not an automatic reply from a robot, it's an actual person there which is willing to help. And of course, if you cannot help through the live chat, he will give you a call straight away. So moving on, let's start to look at why your position size is important. Now, when opening a trade, before opening a trade, you should know when you're going to enter, when you're going to exit, the potential risk, the potential profit, and your trade size, okay? So we mentioned this at the very beginning. So if I'm looking at this market movement, this is an old market movement. This is the market movement which is currently taking place within the market at the moment. It's actually gold against the US dollar. Now, what a lot of people do as well, this we mentioned last week, and people gave a lot of great feedback about this, is they measure every type of wave. So when we get an impulse wave, a corrective wave like this, they'll measure it. Then the impulse wave, they'll measure it. Corrective wave, they'll measure it. Impulse wave, they'll measure it. Corrective wave, they'll measure it. Impulse wave, they'll measure it. Corrective wave, they'll measure it. And now keep this into consideration when they're trying to determine how the market is likely to move. Because what you actually can see, ladies and gentlemen, is for this asset at the moment, okay, keep in mind, if you keep measuring, the calculations will keep changing, because what you want to have is what the largest correction is, the largest impulse wave, the smallest, and the average. Okay, the most important, especially for people who are slightly more risk averse, is the smallest to the average, that bracket there. But you can see if I'm measuring the price movements, all of these pullbacks here, ladies and gentlemen, are identical. They're the exact same. So you can really measure that and use that to determine potentially when that next impulse wave is actually going to take place. And also when you look at the impulse waves, they are also very similar as well. We've got 1%, 2%, 2.5%, almost at 2%. They're very similar. So what you can do is you can add this, divide it by 3, come up with the average, and then say, you know, the smallest price movements will bring me up to here. The average price movement will bring me up to here. So for example, you may have, because of that, a target 1 and then have a target 2. So I'm going to enter at this point of the market, but before I've even entered, I know I've got one target and I've got a second target here. And I also know if the market moves against me, this is where I'm going to exit the market. Okay, this is where I'm going to exit the market. Now, before entering the trade, I need to look at my position size, and I need to see the position size and what it means if I go to target 1, if I go to target 2, or if I actually go to point number 3, which is here, and I'm actually going to be in a minus, because nothing should ever be unexpected within the market, ladies and gentlemen. So this is what I need to take into consideration. How much am I earning at target 1, target 2, and how much would I be losing if I exit at the exit point 1? Okay, this is why the position size is important. So for example, if I'm opening one lot, okay, it may potentially mean that at this target here, I'm earning 1,000. And at this target here, I'm earning 1,100. And at this exit, I'm losing 3,000. Okay, now if I've got an account size of 5,000, that's not a very clever trade. Okay, I'm very exposed. It's a very large trade. If the market moves against me, I'm losing more than 50% of my account, which is crazy. Just as an example. So here we can see that based on a one lot, based on this position size, it's something which is not responsible trading. So for example, I may open a smaller position size. So for example, I may open a position size of one, we can say a micro position, we can say a mini position potentially, but just for an example, we're going to have a position size of 1.10. So instead, I'm actually earning a profit here of 100. I'm earning a profit here of point number 2 of 110. And at point number, the exit number 1, I've got a loss of 300. Now, based on an account of 5, 6, 7,000, this is something which is more appropriate. And again, you can open a smaller position as well. You can open a larger position. You can place your exit slightly higher up. This is just an example, though, ladies and gentlemen. Okay. The main thing that people need to understand is 2 things. You should know your exit before entering, whether it's in a profit or in a loss. Point number 2, check in terms of money what your profit will be and what your loss will be. If it's something which is inappropriate, if it's something which is not responsible, or if it's something which is not in your line of risk appetite, because some people are risk averse, some people have a very high risk appetite, which is absolutely fine as well. Make sure that the actual money worth of targets and exits is something which is in line with what you're looking for. Nothing should ever be a shock to you. So some people should never say, I can't believe I quadrupled my money within a month. If you quadrupled your money within a month, you could have lost 80% of your money within a month as well, unexpectedly. Okay, so nothing should be unexpected. All right. This is something which is very, very important. Now, the other thing I want to speak about, this is now actually starting to look at in terms of position size, how we can use the position size to better us as traders and to better our entry and our exit. Now, something people can take into consideration is something which is known as scaling in and scaling out. So the idea, ladies and gentlemen, of scaling in and scaling out is to mitigate the risk. Now, what you're trying to do is spread the risk of entering and exit the market at the wrong or incorrect area of the market. So in the box on the right, I say a lot of people are great at identifying the trends. So some people can say, you know, the NASDAQ in 2024 is going to see an upward trend. Great. Okay. You've identified a potential price movement, which is spanning 12 months. Somebody inexperienced could have said in 2023, the NASDAQ is going to see an upward trend, but it's useless as a trader. There's no point being able to identify something which is going to happen over the next 7 months if you're not able to identify how the price is going to move in the short term, because you are trading with leverage. This is what people need to understand. The NASDAQ may see a very strong upward trend over the next 12 months, but what's going to happen to the NASDAQ today is important. What's going to happen to the NASDAQ tomorrow is important. There's no point you opening a trade now, speculating the NASDAQ is going to increase in value, whereas actually March is going to decrease in value. Okay, that's not how to be a successful trader. So how can we help individuals who are great at identifying a longer term trend, could be medium to longer term, find a better entry in the short term? And what we can do is mitigate risk, we can spread the risk through scaling in and scaling out. So what can we potentially do? Now, instead, ladies and gentlemen, of opening, let's say, buy position here. So here we've got a buy position. So here I'm speculating upward price movement. Instead of opening here one lot, okay, let's say we're trading the euro against US dollar. So here's 100,000 in a single trade. Instead of opening one large trade here, what we can instead do is what is known as scaling in. So instead of opening one large trade at one price at one time, we open small trades at multiple prices at multiple times. So for example, I instead will open 0.25 lots here, 0.25 lots here, 0.25 lots here, and 0.25 lots here. So here, ladies and gentlemen, this is what is known as scaling in. I'm not trading less, I'm trading the exact same amount, because on one trade, I've got one lot, whereas here I've opened 4 trades, but 4 times smaller. And I'm opening it at different times and at different prices. So I don't have to be correct at this price here. I just need to be correct at this bracket here. So it's better to say, for example, if you're throwing darts, would you rather throw darts and try and get a line? Or would you rather throw darts and try and target a whole square? Okay, the same thing applies. This is what is known as scaling in. And you can also scale out. So this is known as scaling in and scaling out. So for example, I may put one target here, a second target here, a third target here, and a fourth target here. So trade number 1 has a target to here. Trade number 2 has a target here. Trade number 3 has a target here. Trade number 4 has a target here. So I'm spreading the risk in terms of entering, and I'm spreading the risk in terms of exiting. Okay. So we also need to take into consideration we're avoiding the risk of missing the price movements, because somebody said last week, I'm very scared about missing the price movement. I may have a specific price in mind, I really want to take advantage of it, but I'm missing that price movement each and every time. I can't find the manual for this webinar, somebody says. If you message the live chat, they will send it to you, if you're referring to the PDF. So somebody says, how can you calculate the terminal head of the exact possible amount to earn at a particular point? Go to the home page, go to tools, go to trading calculators, and there's a calculator there for you. And there's also a calculator which is known as multiple target calculator, which is if you've got more than one target, where you have your leverage, you have the trade size, you have the price which you're entering, and you can put all the targets there, and it will say to you, at target number 1, you will earn $10. At target number 2, you will earn $20. Target number 3, you will earn $30, and so on and so forth. You can also have one target if you prefer as well. So hopefully that answers that question. So missing the price movement, a lot of people are scared of missing the price movement. So some people may, for example, measure this impulse wave, okay, and they say the impulse wave is at 0.25%. And then we've got further impulse wave upwards. We've actually got a breakout as well. We've got a higher high. We've got a higher low as well. So people may say the upward trend is going to continue, but we're in a retracement. I don't want to buy while the price is declining. I want to buy when the price is increasing and not fight the price movement, which is understandable. So some people will measure and say the previous retracement was here at 0.25. So this is where I'm going to enter. Whereas the price actually declined to here, didn't decline any further, and then started to move up. So you missed the price movement. Whereas instead, if you look to scale in, you could have entered, say to yourself, the smallest retracement, if we measure price movement, is here. The average is here, and the largest is here. Okay, so I'm going to open a pending order for here and a pending order for here and here. So even though it didn't decline to here and didn't decline to here, I've still managed to enter a trade. Okay, so here you can see how you can use scaling in to ensure you're not missing the price movement. Okay, especially if you're measuring previous waves. Okay, if you're measuring all the impulse waves, all the corrective waves, and you're looking at well, the smallest is, the largest is, and the averages. You may, for example, say to yourself, I want to place a pending order to scale in at the average and the smallest, or the average and the largest, whatever it may be. Okay, but you can use scaling in and scaling out to help. Now, something you should be cautious of, though, this is the last thing I'll mention, is you shouldn't use scaling in as a martingale strategy. So martingale strategy is basically when you keep fighting the trend. Some people also know it as trying to catch a falling knife. Some people know it as, for example, fishing for the bottom, and so on and so forth. It's not scaling in, so you're not doubling, sorry, you're not martingaling. It's not doubling your trade size each time. So if somebody's speculating the price is going to decline, they may speculate here and open one lot. As the price increases, they'll speculate here, open 2 lots. Here they'll open 4 lots, and so on and so forth. So you keep opening trades against the trend, and you keep being more exposed against the trend, which is definitely, of course, more risky. How can I have the PDF file for this class to download? Message live chat, and I'll provide the download for you. So this is a chart where I'm looking at, excuse me. So this is the chart where I'm looking at speculating that the price is going to decline. It's actually gold. I don't think the price is going to decline anytime, imminently today, for example. So I don't want people to look at it and say, I'm going to go straight onto the chart and start speculating to the declines. This is just an example. Okay, so keep that in mind. So here, ladies and gentlemen, the price is increasing. I may think it's too expensive. I may look, for example, here at the RSI and say there's divergence there. It's overbought in terms of its status. It's very high above the 75 bar exponential moving average. So maybe it's going to actually retrace back to this trend line because it's very, very expensive. Okay, some people may believe that. It's absolutely fine. but scaling in and scaling out. Let's look at an example. So instead of opening one large trade here with one exit here, you can scale in and scale out. So for example, you're splitting the trade up. So I open one trade here and I aim for this target, open another trade here, I aim for this target, a third trade and I aim for this target, and a fourth trade and I aim for this target. So you can see here I'm spreading the risk across 4 different trades, 4 different prices, 4 different times, and 2 different exits. Now you can just scale in or just scale out, it's absolutely fine, or you can scale in and scale out. This is another example here. Here, ladies and gentlemen, I'm showing you a real example on gold. This is actually taken from today, 6-minute time frame, on how you can use this to trade retracements and also to ensure you're not missing the price movement. Now, if I measure short-term retracements, it's only a 6-minute time frame. The smallest retracements tend to be 0.20. The average retracements are 0.30. The largest retracements are 0.40. Now, if I measure the latest retracement, is 0.30. This is the latest retracement, it's 0.30. So if I go to the retracement and I say, I'm going to place a I'm going to buy an order at this price here, okay, I would never enter into the market and I would have missed this beautiful upward price movement here. Why? Because the retracement actually was 0.27%, so I missed the price movement. Whereas if I said to myself, I'm going to scale in and look at different options, I've got an entry point here, an entry point here, and an entry point here. So the smallest, the average, and the largest. You don't have to work off the smallest, the average, and the largest. You may use price action. You may use an indicator. A lot of people used to scale it in using crossovers because, of course, if you're on a 1-minute chart, a 2-minute chart, there's a lot of crossovers. So people may use scaling in at each crossover. So in an hour, we may have, for example, 10 different upward crossovers on a 1-minute chart. A lot of people use that to enter 10 different trades rather than enter one trade on a crossover on a larger chart, for example. But here you can see how this has ensured that you have entered into the market. Whereas if you use 0.30 or 0.40, you would have missed the trade and you would have avoided buying and trading this lovely upward price movement. But because I'm scaling in using different options, it's giving me a better possibility of entering the market and a better possibility of actually entering at a better point in the market. And then also, what it also means is if I entered one lot here, ladies and gentlemen, okay, so here, for example, I have one lot. We've got one more slide and then the webinar is going to end, and then you can ask as many questions as you like. If I'm opening one lot here and the price keeps moving against me, and it moves against me all the way down to here, my loss may be quite large because I'm buying here, I'm buying here, and I'm buying here. So if the market moves all the way down to here, I may be on quite a large loss. Whereas if I'm not using one lot, okay, and I'm not trading just one trade, okay, instead I've opened 0.33 here, 0.33 here, and 0.33 here, instead of not opening 3 trades, just opening one trade at a higher price and opening 0.1, my loss will be much less because 1/3 will be at a lower price and 1/3 will be at an even lower price. So as the market moves against me, my loss is very minimal. Okay, so I'm more comfortable to keep hold of the trade, give the market more time for it to move back into my favor. This is one benefit. The other benefit is, of course, if the retracement isn't that large, it's ensure that at least part of the trade has entered into the market. Okay, so this is another thing as well. This is the last slide, and then we'll exit today's webinar and we'll answer all questions. How do you calculate profit and loss? 2 options. You can do it manually. You can look at using the cross tool, working out how many pips price movement is going to move in your favor and work out the value per pip. And that will confirm to you if you times the pip movement and the value per pip will confirm to you your profit or loss. But why work it out? Why do it manually? Like I said, if you go to our homepage, you go to tools, you go to calculator, there's a calculator there which will show you how to calculate potential risk and how to calculate potential profit. Okay, so keep that in mind. It's much better to use a calculator because it confirms to you without you having to calculate it personally yourself. So risk management for beginners. Consider only trading one asset. The more assets you trade, the more difficult it will be. The more assets you trade, the more difficult a trading plan will be, analysis will be, and the more difficult trade management will be. If you're trading one asset, you will learn more, you will learn faster, which is extremely important. For example, when you go to university, you study one subject. You're not going to study 5 different undergraduates. So when you go to trade the financial trading markets, why are you trying to trade 10, 20, 30, 50 different assets, or every single day trade a different asset? Pick an asset, stick to the asset for the long term. Because if you're only trading one asset and you've only been trading that one asset for 2 years, your knowledge and your experience and your skills are going to be so much better than somebody that's been trading 2 years and been trading 1,000 different assets. Okay, this is very easy risk management. Reward to risk ratio versus your success rate versus the amount of trades you're opening per week. So always think to yourself, you're opening a certain amount of trades. You should know how many trades on average you open per week. So for example, if I open in 10 trades per week, look at how much I'm risking. And you also know your success rate. Unless you've never traded before, you should know your success rate. So you should know I open 10 trades per week. Normally, on average, my success rate is 80%. Okay, so I know that 8 trades I'm in a profit, 2 trades I close in a loss. Now, you need to look at your reward to risk ratio. So you need to say to yourself, I'm looking to earn per trade, for example, $30, and I'm looking to risk per trade $40. So I know 30 times 8 is 280, and I know 2 times 40 is 80. So based on 10 trades, 80% success rate, so that's 2 trades in a profit, 8 trades in a profit, 2 in a loss. I know my reward to risk ratio. I'm earning on every trade, aiming to earn $30. I'm risking 40. So I know I've got 216 profit, 18 loss. So I'm earning $180 per week. What am I doing, ladies and gentlemen? I'm looking at the mathematics of my trading. Okay. What do you need in order to do so? You need the success rate, the amount of trades you're opening every week, and your reward to risk ratio, and what the reward to risk ratio means in terms of actual capital. All right. You shouldn't necessarily be changing consistently all the time the amount of trades you're opening per week, the success rate, and the reward to risk ratio, unless there's a reason for you to do so. And again, it would definitely be all the time, again and again and again. Because very simply, ladies and gentlemen, management is going to be very difficult if you do so. Moving on, when appropriate, take into consideration scaling in and scaling out. If you are cautious and worried about exposure, use the 1% rule. Very well-known rule. You can type it up in Google. It's very well-known. It's been around a very long time. So if you're not sure how much to be exposed and you want to keep exposure and risk as low as possible, very simply just trade no more than 1% of your account. Okay, or you can say position size is going to be 1%, and I'm not going to have exposure overall more than 10%, which is also a very well-known strategy. Do not keep open losing trades without reason, and do not fight the trend without reason. This is one of the main reasons why traders lose. And the last thing I want to mention, because we've been speaking now an hour and 5 minutes, is to monitor correlations and the line of influence of each asset. For example, look at the assets and say, what is influencing the assets? Is it bond yield? Is it stocks? Is it risk appetite? Is it sentiment? What is it which is influencing the asset? And each day, look at those influences and build a bias for the day. So for example, if we look at the NASDAQ, here I've got the 20 most influential stocks for the NASDAQ. This is the 20 most influential. What can you see here? I can see today only one is increasing in value. So ladies and gentlemen, we've got 19 of the 20 most influential stocks declining and one increasing in value today. This is just for an example. Keep that in mind. Are you going to look at speculating the price is going to increase or decrease? So you can see here, I'm using the line of influence. Okay. So ladies and gentlemen, that actually brings us to the end of today's webinar, because we've been speaking now almost an hour and 10 minutes. If anybody has any questions, feel free to ask now. I will leave 2 minutes available if anybody has questions. How to set trades to a break even or closing half profits. What you can, in terms of half profits, ladies and gentlemen, what I'm guessing you're referring to, you haven't reached your target and you want to close half of the trade. What you can actually do, instead of trying to close half of the trade, you can do it. You can right click, for example, and do it. But another option is scaling in and scaling out, which we spoke about. So instead of opening one lot at that price, open 4 trades at 0.25 lots. So then you can close 25%, 25%, 25%, and so on and so forth. Or you can close 10%, 10%, 10%, 10%, and so on and so forth. Whereas if you're trying to close part of the trade, you're limited in terms of the options. Whereas if you're scaling in and scaling out, you can personally manage it yourself. So hopefully that answers your question. Any other questions, ladies and gentlemen? Please send me the video or audio to my email, please. If anybody wants the PDF or the recording, they have to request it via live chat. Live chat is very simple. Just go to the website. You'll see on the bottom right the option for live chat. Send them a message. Please send me the PDF and recording, and they will send it to you, of course. Somebody says, how do we get information for correlations and line of influence for currencies and over-the-counter data for institutions? What do you mean by over-the-counter data for institutions? That's not possible. If you're trying to get access to order flow, if that's what you mean, you need to use order flow tools. So go to Google, type in order flow charts, and there's many options there for you. In terms of correlations, we have certain webinars where we're looking at different correlations. But if you want them instantly, type in the asset and type in correlations, and it will come up with the list of all the correlations for you. Where is the live chat located? If you cannot, it's on the bottom right. If you cannot locate it, the simplest option is just go to Google, type in HF Markets live chat, and it'll take you straight to it. Or alternatively, you can send us an email again to the support team. That's also an option as well. How does leverage come in when you're calculating profit and risk per trade? Again, if you go to the website, you go on tools, go on calculators, it will request your chosen leverage and it will do the calculation for you. Because of course, depending on your leverage, the profit and loss changes. Okay, so when you're looking at the calculation, it does it automatically for you. It's the simplest way rather than trying to work it out and using the calculation yourself. It's better to use the calculator because it's automatic, it's instant, it's quick, and there's no room for human error there. So I can see that's all the questions we have for today. Trade safe, ladies and gentlemen, trade responsibly, and we'll speak very, very soon. We have a webinar tomorrow and on Thursday as well. In the meantime, trade safe, trade responsibly, and we'll speak very soon. Goodbye.